Couple questions that came in this week during coaching sessions, of course, are related to the market in general and expectations in general as well. I don't have a crystal ball, even though my family goes way back to the days in Romania. Part of my family goes way back to the days in Romania. I don't really have a crystal ball. But again, to review what we talked about a couple weeks ago, what is the market doing? It's doing a melt up, and this is the past 6 or 7 months, going back to January. I'm going to go back year to date, actually. There we go. Since January 1st. And what have we been seeing? Well, it's been a consistent melting up with a small 2 or 3, 4-point correction percent. And melt up, and then a little hesitation. Melt up, little hesitation. Melt up, good period here, little hesitation. Melt up. That was a big hesitation. This was a pretty big hesitation last month, right? It was kind of sent fear a little bit to everyone. And then we're back to melting up again. Still pretty strong, even with this, what we're looking at on a daily thing, it's still pretty strong growth, isn't it? We're here at 370 roughly. Now, okay, let's call it 375. My apologies. Better probably call it 380, 375 at the start. And yeah, we're up here now at 445, close to it. Let's call it 440. 65% or 65-point increase with some hesitation in there. And the last big bearish, consistent bearish decline we saw, remember, was back in September. It was almost 3.5 weeks long, almost the whole month. Now, am I trying to say that I expect this pattern to continue? No. But there's been a lot of investors who've asked questions. You've heard me talk about the strategies I prefer. They don't have to be your strategies. That's why Power Options is so excellent. We offer the search tools and education in over 23 of the most commonly used option strategies. I just know what works for me. I prefer to use married puts and collars, protected positions with a large portion of my portfolio, the larger portion to protect it, 50, 55%. And I'll use similar bull put spreads with about another 10 to 15% of my portfolio. I like the standard calendar spreads. Poor man's covered calls right off the bat with about 10%. Why poor man's covered calls? Why the diagonals? Well, there's a lot of stocks I like that are trading in price ranges that I can't trade for a married put or for a collar. Well, rather than pay $450, $500, $600 for a stock, hey, I'm going to pay $2,000, $3,000, $4,000 for 1 or 2 contracts of an in-the-money call 5 to 6 months out, then sell calls against it. And I may speculate with a few percentage here and there on long straddles for earnings. And of course, I may go ahead and buy VIX calls or buy shares of UVXY or buy puts on SPY when we start running the top of this here again, and I start to see a concern of hasn't made sure what it's want to do yet with the MACD. When you see that negative MACD crossover, might consider buying some puts 30 to 45 days out. We had a webinar on that recently on insuring the portfolio. But questions always come in, and why aren't you getting more profit than the bull put credit spreads by doing an iron condor? Why aren't you doing something that gives a better credit like an iron butterfly position? And the two answers to that mainly, let's go back to Power Options very quickly to discuss some of the reasons why I don't do other strategies personally. That doesn't mean they're not good strategies. It just means for me personally, my account size and the time I have to devote to trading, since you guys know what I normally do during the day with webinars, coaching sessions, and more, I don't want to be in a lot of elaborate strategies that I have to track on a consistent basis. Iron Condor is not a bad position. I had mentioned that you've heard me talk about the ways that we prefer to look at bull puts and everything along those lines. And the Iron Condor is essentially a bull put on one stock combined with a bear call credit on the same stock. And as long as the stock stays between the short put and the short call strike price, all 4 options expire worthless. You get potentially double the net credit you would on a bull put credit spread. So why am I not doing this? Why am I not doing Iron Condors? Truth of the matter is I haven't looked at Iron Condors in almost 6 years. Because it was about 6 years ago. I don't want to go 1 decade, but I'm going to go 5 years to 2016. That's about right. This is what the market started doing. And you might not think it's a big move. We're talking here from about around 220 to, at the end of a year and 10 months later, a year, almost 2 years later, to about 270. But this was the start of this run, a little hesitation, big hesitation here, and then this run again. And what does that mean? That started to mean when this started to take off late 2015, it did move up 2015 and came back down to settle. When this move started, I would have been closing 35 to 50% of the iron condors on the bear call side. I prefer to ride the trend and with the bullish. Now, yes, I lost on bull put credit spreads here, but I would have lost on them anyway in the iron condor. And then maybe one management here, a lot of management here on the bear call side, maybe one there, some here, and then a lot coming off again, of course, on March 20th. Now, this looks really steep, doesn't it? It's from about 405 to 450, or 440, where we are now. That looks like a pretty steep increase. The truth of the matter is, for iron condors, I think the only time, maybe sometime back in 2016, maybe a couple months over here when we were in 2018, but that got really risky. That was a bad year. If you think about 2018, that big drop February 5th through 8th, which is what I knew that was, and then this was that October to December decline. I wasn't in bull puts then, believe me. So, long story short, in the last 6 months, this might have been a better time to do iron condors. But for me personally, I don't think the last 4.5, 5 years was a great time to have been doing iron condors. And there's still some places here I can see where I would have been caught on the bear call side. And I know I would have been caught on the bull put side because I was caught on the bull put side. But even on SPX, this here, you can see it. This would have caught me on the bull put side for sure. Maybe, depending on how far out of the money I went. Most likely here. Probably here, but it came back quickly, so it might have been okay. Here, I would have got caught on a bear call side. I can just tell by the movement. And potentially here, but I would have been able to catch it and get out of the way of the train. Maybe here, depending on the time frame I entered. If I entered back here, absolutely. This would be the call. But if I entered back here, I'd still probably be perfectly fine. This might have gotten me caught on the bear call side if I'd opened somewhere in this time frame. It's hard to gauge. I probably would have been okay. But about 2 or 3 times on the bull put side, and as you can see, 2 or 3 times on the bear call side. So that's why I don't do personally iron condors, because the market conditions, with the exception of maybe the last 6 months, haven't been right for that structure. And then you can say, oh, well, you can always find a good bear position. Well, if I'm getting my goals at 15% on a bull put credit spread, with an 85% success rate, 86% success rate on average, I'm hitting my targets that I want. Why complicate it with the extra leg so I could make a little bit more profit? Or you say, oh, just go further out of the money and get an extra 10 or 15 cents. Why complicate it? Why not just stay with what's working? Now, lo and behold, of course, the other question that we talk about is iron butterflies. And some of you have heard me say this before. What does the iron butterfly give? Well, it's an iron condor in a sense. You're doing the same bull put credit spread and bear call credit spread, but the call you're selling and the put you're selling are at the same exact strike price. This will typically give you a higher net credit than an iron condor position. And you still have a good wide range of profit. And where the iron condor might be offering a 12 or 13%, maybe a 15% return on the risk, butterfly might be showing the same security. A butterfly might be showing a 25 or 30%, maybe more, maybe a 40% return because of the at the money premium. So why not do this? Well, the reason why is because the investors that are successful with iron butterflies and trade iron butterflies are consistently moving one leg or the other. You can't look at this and say, oh, why not do this? This is almost double or triple, perhaps, the return I could make in iron condor. Only 1% of the time will you make that max profit. Because you're selling a call and selling a put that's right at the money. This is about the most neutral thing you could do other than a short straddle, where you don't have the outside wings for protection. Your naked call, naked put right at the money. Eventually, you have to close one of these too. About only 1% the time are you ever going to see this maximum profit with a little bit amount of work. It's probably 0%, but close to it. By max profit, I mean within 0.5% of the maximum profit. Maybe 10 to 15% of the time you'll be down here. Probably about 30 to 40% of the time, with little to no management, you'll be right in this range where you're still profitable, but not as much as maybe just a standard iron condor. And then down here, of course, you're probably going to see that about 10% of the time. And down here, of course, 5%, you'll hit the maximum loss in this way, and 5% maximum loss in this way, give or take a few percentage. But that's in general what we've seen with just standard back testing without management. You are going to have to manage. Why? Because that's one of those sold calls or that sold put's going to be in the money. To avoid being put the stock or to avoid being short the stock, you're going to have to roll it. You're going to have to close it. You're going to have to move it. Got to do something. Okay, so that's why I don't trade butterflies, because I don't have that much time during the day to watch those positions. Even if it's 2 months out or 3 months out in time, it just doesn't work for me. Okay, so what I'm saying here again, the reason I brought this up is just some general discussion of what we've seen in the last 6 months. Iron condors probably could have worked, but I'll never trade the butterflies. I'm still sticking with the bull puts for right now without converting to an iron condor unless I decide to use that as one of my management techniques. Now, I'm not saying this particular pattern is going to continue. Most people are worried about a correction. Probably the 4 or 5 discussions I had this week, some coaching sessions, some straight calls. One of our favorite, great customer we have, Terry and Cliff, they're out in California. They called and wanted to ask me about what are the bearish strategies you would do in the market if you're expecting a correction. My answer was, first, I wouldn't just shift into bearish positions if I'm expecting a 5 or 6% correction sometime in the next 60 days. I'm going to manage my existing long positions, add protection to them, try to bulletproof those. I'm going to put myself in a position where I'm lightening up on the bull put credit spread so I don't have much exposure. And then if the move happens, I might look at the bearish strategies for maybe bear call credit spreads or something along those lines. But I'm not going to just turn the switch. I've got to protect what I already have. I've got to ensure the positions I already have. I've got to lighten up on some of the more exposed leverage positions that can take high losses if that's my expectations. Maybe skip a cycle if I'm worried, skip a cycle of bull put credit spreads if I'm worried.